Hello and welcome. My name is Steinar Quifty. I'm the Nordic IFRS desk leader in EY, and I'm also a partner in the Global IFRS Services Group in London. And I'm the chair of our subject matter group on presentation and disclosure. Today, I have with me Twan van Limp, who's a partner in the Dutch professional practice department in Rotterdam, and Twan is also a member of the P&D SMG. Most of you, hopefully all of you, will be aware of the last few years' developments with respect to alternative performance measures, often referred to as APMs or non-GAAP measures. There has been an increasing use of these type of measures across the board, and this has triggered some concerns among regulators, among users, and now most recently the IASB has also tried to address some of these concerns in an exposure draft that was released just before Christmas last year. The general presentation and disclosures ED was released on December 17th. It is the output of the so-called primary financial statements project and is a proposal that is intended to replace the current IAS1. Today we will discuss the part of the ED that addresses alternative performance measures. But first, Twan, could you please explain what an APM is all about?
Of course, Steinar. An alternative performance measure is basically any measure that is not defined in the applicable reporting framework. And as you can imagine, that depends on the reporting framework that is applied, which in our case usually is IFRS. An alternative performance measure, or APM, typically can be a subtotal in the income statement, but it can also be an item in the balance sheet, like a solvency ratio or liquidity ratio, and it can also relate to cash flows. It actually also can be a result of combining such items in the balance sheet, in the income statement, and or in the cash flow statement. So it can be a variety of such things.
Thank you, Twan. It's quite interesting. It sounds like the APM concept is rather broad, almost like it's only restricted by the imagination of a preparer. Is that true?
Yes, Steinar, that's actually true. It's fair to say that there are a lot of APMs out there. Some companies only use a few, but we also did a survey where we identified companies that use 10 or even more than 20. We actually found over more than 120 APMs used by 27 companies. So there's a lot of variety out there.
Twan, some argue that the increasing use of APMs is in response to the perceived inadequacy of IFRS numbers or measures, i.e. that the financial statements are not really providing the information that is required by a user. Is that a criticism that you would subscribe to?
Yeah, that's a good question. I do think, however, that's important to remember that APMs and the financial statements may serve different purposes. I think the financial statements are typically focused on looking back, what has the company achieved over the last period, and how does that compare to the period before. I think APMs typically are used by companies to have a more forward-looking statement, so to also make more of a valuation of the company going forward. So I don't think it's so much that they conflict with each other. I think they rather should complement each other in order to get to a good view of the company.
But if APMs and IFRS measures are going to work well together, there must be some ground rules applicable to APMs as well, I guess.
That's right, and that's actually where most of the regulators come in. So we have seen regulators from Europe, from Australia, from the United States take actions on those alternative performance measures, particularly because they are typically not presented in the financial statements, but rather in the board report or in the MD&A. And they typically focus on similar items. So there's a lot of consistency between regulators on what they would like to see on those APMs. And you can see that they focus on definitions, on labeling, having reconciliations with GAAP numbers and the like. And they should also be presented with similar prominence. So the regulators take a lot of focus on those APMs lately.
But Twan, if those guidelines are already in place, what is really the concern of regulators and users these days?
Yeah, those concerns can be split into two categories, I think. First is that the APMs, the regulators focus on APMs as applied outside the financial statements. So there's less clarity about APMs within the financial statements. That has been the focus of regulators so far. And the other part is that if you look at those APMs, it's quite easy to think of guidelines on what they should adhere to and how they should look like. But it takes a lot of manpower to actually enforce those priorities. So I think those are the two challenges so far.
Let's focus on the first category or the first concern, the lack of prescriptiveness on with respect to APMs in the financial statements. Because that brings us back to where we started, namely the recent exposure draft of the IASB from December last year. Could you just give us an update on what the ED talks about in the context of APMs?
Yeah, you mentioned rightfully that the IASB issued an exposure draft about general presentation and disclosures, and part of that relates to management performance measures, so MPMs as opposed to APMs, and they define an MPM as a subtotal of income and expense that is used in public communication outside the financial statements. They complement totals and subtotals as specified by IFRS and are communicated to users of financial statements, management's view of an aspect of an entity's financial performance. So they quite focus on subtotals or new sums in the statement of financial performance, so in the P&L. And they require that all those MPMs are disclosed in the financial statements, and they will be, or they should be, disclosed in a single note. And all the information that they require is quite similar to the information that regulators would like to see about APM. So they also focus on definitions, reconciliations, explanations, and the like.
Yeah, but that actually raises a few questions because, well, the first question that comes to my mind is, it seems that the definition of MPMs that you just described is quite a bit more narrow than the concept of APMs that we discussed before, isn't it?
That's correct. MPMs are defined in the exposure draft as being subtotals of income and expense, which also means that items that relate to the balance sheet, like solvency ratios or liquidity ratios, are not defined as MPMs in the exposure draft.
Exactly. But what does that really mean? Does it mean that APMs other than MPMs cannot be disclosed in financial statements? Or does it mean that you can still include APMs that are not MPMs in the financials, but then with less onerous requirements, disclosure requirements applicable to them?
Yeah, that's a very good question. And based on the exposure draft, we have not been able to reach a conclusion on that particular item yet. So we also intend to include that in our comment letter to be raised to the IASB before the 30th of June. So we still have quite some time on that one. But it is a key question what to do with those alternative performance measures that are not defined as MPMs. And if they would still be allowed to be included in the financial statements, which, like currently, it's quite unclear. That means that you have different requirements for MPMs compared to those APMs, which kind of seems redundant in some way.
Thank you. And there is another question that comes to my mind that I think many entities and companies would be quite keen to understand is this is presented in the exposure draft as a disclosure requirement. Does that mean that you can only disclose MPMs in the notes, or could you also present MPMs at face of the income statement?
Well, I think there are a number of things that needs to be considered. First of all, the exposure draft requires that MPMs need to be disclosed in a single note to the financial statements. Secondly, the exposure draft also clarifies that you are not allowed to use a column approach in the P&L in order to have these MPMs presented on the face of the income statement. And secondly, the exposure draft also prescribes that you have to present the income statement based on either the functional model or the category model, which basically prevents some of the mixed models that we see today. And if you combine all those requirements, it seems very difficult to have MPMs presented on the face of the income statement going forward. Furthermore, the exposure draft also defines some subtotals already, like operating profit. So if you really would like to have the MPMs or the APMs you have today presented on the face of the income statement, that probably proves to be quite difficult.
Yeah, you mentioned a set of new subtotals, Twan. Is EBITDA probably the most common used out there? Is that one of those subtotals?
No, it is not actually, and the board have asked for feedback on that particular statement, so whether they should include EBITDA in the ultimate standard to be issued, but so far they have not, and probably that is because EBITDA means a lot of different things to different people. If you look at companies' definitions of that, some include all interest, some include some, but it also does not fit particularly well in most traditional income statement approaches that we see in practice. The board have defined operating profit or loss before depreciation and interest, which probably reconciles with some measures of EBITDA used by companies.
Yeah, the last thing I wanted to ask you about, Twan, is before we close. Regards the issue of non-recurring items. Non-recurring items is a type of an APM that is quite commonly used across industries, across jurisdictions. Does the ED address that particular topic?
Yes, it does. The exposure draft defines unusual items of income and expense, and they are defined as those income and expenses that have limited predictive value, meaning that it is reasonable to expect that items that are similar in type and amount will not arise for several future annual reporting periods. And although that sounds rather easy to apply, it may be quite difficult in practice because it has a predictive nature. You have to look into the future. You have to have expectations about what will or will not happen going forward, but that might be difficult. The board have clarified some items already, like fair value changes. They do not regard them as unusual because typically you will expect them from period to period, although the amount may differ. But there still will be judgment out there, although you might expect that it will be more consistently applied than some items that we see today, which don't have a definition, like non-recurring, one-off, and similar items.
Yeah, on that last point of yours, consistency across entities, is the proposal to require disclosure of these unusual items, or is it a voluntary disclosure?
Well, it actually is a requirement. So companies will have to disclose unusual items in their financial statements if everything turns out the way the exposure draft is written. And that might be difficult for some companies because it also requires some kind of completeness check to be performed. How do you know that you identified all unusual items and that they will not occur again in some future period? So it can be quite challenging to apply that and to be consistent from period to period and to be complete.
Thank you, Twan. That wraps up this video. Before closing, I wanted to remind everybody about the deadline for commenting on the ED. The deadline is June 30th. Later on this year. We have only addressed a particular aspect of the ED today, and you may want to listen to another video of ours entitled Better Communication and the Primary Financial Statements, which provides you with a bit more thorough update on the topics that are addressed in the ED. Also, please be aware of the webcast Better Communication in Financial Reporting that was presented on March 24th. A replay of that webcast can be found on ey.com. So with this, we thank you for listening. And if you would like any further information, you might also refer to our Applying IFRS on Alternative Performance Measures, as well as our IFRS developments on the ED. And both of these can also be found on ey.com. Thank you. Until next time.